In 1907, the U.S. financial system nearly collapsed, and the man who saved it wasn't a government official, he was a banker working from his office. Most people think the Federal Reserve prevents financial panics. It was created in 1913, right? So before that, America had no safety net, no circuit breaker, no one in charge. That's the story we're taught. And it sounds logical. Without a central bank, chaos should have been constant. But here's the thing. The worst panic before the Fed was created happened in 1907, and it was stopped not by government decree, but by one man's personal fortune and reputation. J.P. Morgan wasn't the head of the Treasury. He wasn't appointed by Congress. He was a private banker, one of the richest men in America, and when the financial system started to crack in October 1907, he essentially took control and fixed it himself. Understanding how he did that requires understanding what actually broke. The panic didn't start with a single event. It built up over months. Confidence in banks was already fragile. There'd been a recession, some railroad stocks had crashed, and people were nervous. Then, in late October, a major financial operator tried to corner the market on copper, basically, buy up all available copper to control the price. It failed spectacularly. He lost millions. When word got out, people panicked. If one major player could lose that much, what else might be hidden? That panic spread like a cold. Depositors rushed to banks to pull out their money. Banks couldn't pay everyone at once. That's not how banking works. A bank takes your deposit, lends it out, and keeps a fraction in reserve. When thousands show up demanding cash simultaneously, the bank runs out. It's like a grocery store that only stocks enough milk for normal shopping. If everyone comes in at once, the shelves empty. Banks started failing, not because they were insolvent, meaning they owed more than they owned, but because they couldn't meet immediate demand. Panic spreads. If your bank fails, you lose your savings, so you rush to the next bank and the next one. Within weeks, dozens of banks had collapsed. The stock market dropped 50%. Credit froze. Businesses couldn't borrow to pay workers. Unemployment spiked. Here's where the story breaks from the script. There was no Federal Reserve. There was no government bailout fund. There was no organized system to stop this. So what actually happened? J.P. Morgan called a meeting. He invited the heads of every major bank in New York to his private library. It was late October, around 3 a.m. He locked the doors. Morgan told them plainly, the panic would destroy all of them unless they acted together. He wasn't asking for permission. He was laying out the math. If banks failed, deposits vanished, and the entire financial system collapsed, no one made money. So Morgan proposed something radical. The banks would pool their resources and prop up the weakest ones. They'd inject cash into failing institutions to stop the runs. But Morgan wasn't just asking banks to help. He also went to the wealthiest individuals he knew, guys with liquid cash. He asked them to deposit money into specific banks that were on the brink. Why would they do that? Because Morgan convinced them that if the system collapsed, their fortunes collapsed too. Self-interest aligned with collective interest. Morgan also pressured the Secretary of the Treasury to deposit government funds into certain New York banks. The government didn't legally have to do this, but the Secretary agreed. Why? Because Morgan had the credibility. When J.P. Morgan said this will work, people believed him. His reputation was worth more than any official title. Over the next few weeks, Morgan orchestrated a coordinated rescue. He got the major banks to agree not to call in loans to smaller banks. He got depositors to stop withdrawing money by promising their deposits were safe and making it clear that he stood behind that promise. He even bought up stocks himself to show confidence in the market. It worked. The panic stopped. Confidence returned. Banks stopped failing. Depositors stopped withdrawing. The stock market stabilized. By November, the crisis was over. The financial system survived, not because of a central authority, but because a private citizen convinced everyone else that cooperation was in their best interest. Now, here's the real story. This wasn't a triumph of free markets. It was a triumph of concentration. J.P. Morgan had enough personal wealth and reputation to control the actions of dozens of other powerful people. He could lock bankers in a room and make demands. Not all of them liked it. Many resented being told what to do, but they complied because the alternative was worse. This is why Congress created the Federal Reserve in 1913. Not because they wanted more regulation, many bankers actually supported it, but because they wanted to remove the crisis-solving power from any single individual. The Fed would be a central authority, not dependent on one man's reputation or personal fortune. What's often missed is that Morgan's solution actually revealed the problem. It proved that without a formal system, financial stability depends on the goodwill and competence of powerful people, and that's fragile. What if Morgan had refused? What if he'd been less persuasive? What if he died? There'd be no backup plan. So the 1907 panic didn't disprove the need for a central bank. It demonstrated it. The system worked, but only barely, and only because one person had enough power to force cooperation. That's not a reliable foundation for a modern economy. The real lesson isn't that markets solve everything or that governments must control everything. It's that financial systems need structure. They need rules. They need a backstop, someone or something that can act when confidence breaks. In 1907, that was J.P. Morgan's reputation and wallet. Today, it's the Federal Reserve's authority and the government's credit. Understanding how the 1907 panic was stopped tells us something crucial about how financial systems actually work. They're not self-regulating machines. They're built on confidence, coordination, and concentrated power. When one of those breaks, you need someone, or something, with enough authority to restore it. Morgan was that something. The Fed was designed to be that permanently. If you're curious about how financial systems actually function, not the theory, but the real mechanics of how crises happen and how they're stopped, subscribe. There's a new explanation of how money and markets actually work every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next deep dive into how financial systems actually work. This video is for educational and informational purposes only and is not financial advice. Always do your own research.